a lot is happening, and there's been a lot of commentary and a lot of misinformation about what's going on. So let's level set for everyone and then go from there. So the United States has announced that they're going to be applying 25% tariffs to Canadian goods, 10% on oil starting tomorrow, Tuesday. What does that mean? So a tariff, and again, there's a fair bit of misinformation out there. A tariff is a sales tax on imports, right? So if the US buys something from Canada, the US government is going to charge 25% on top of whatever they pay. Then Canada has decided that it will retaliate with tariffs on the US, which is common. So 25% on a number of US goods. So what's it going to do? It's going to make everything more expensive, and people are going to buy less of it because everything is more expensive. So it's bad for everyone. It's bad for the United States. It's disproportionately worse for Canada because Canada relies more on US trade than the reverse. So there are a lot of estimates out there in terms of how bad this is going to be. Probably the best, in my view, has come from the Bank of Canada that updated their forecast simulation last week with their monetary policy report. And they found that if you get a situation like this where the tariffs are sustained, you end up with about a 4% hit to Canadian GDP. So that's big. That's double-digit unemployment. That's a larger recession than we had in the early 1990s. That's bad. And then part of it depends on the responses that you get. Bank of Canada cutting rates, talked about a fiscal package, etc. But the upshot on all of this is if tariffs are sustained, it's going to be very damaging for the economy, particularly in Canada. The big question right now, and what we're paying most attention to, and I think markets themselves are they sustained? I mean, we could see a situation where the president comes out later today and says, oh, just kidding, not doing tariffs. Or you could say, how dare you retaliate, we're doing 50% tariffs. Or so, I mean, nobody knows. So we have to track this, and we're tracking this, day by day, hour by hour, minute by minute, but that's the state of play right now. Right, so a couple of things there. So first, in terms of our current positioning, so I'm responsible for the multi-asset class funds here at Fidelity, and in particular, the active asset allocation that's associated with that. So the positioning that we've had going into this and for some time, we've been very underweight the Canadian dollar from an exchange rate point of view. So preferring to hold US dollar assets. And that was two things. Number one, Canada's economy had already been underperforming to a significant degree, Canadian interest rates lower, et cetera. And this tariff threat, which is materializing, where one of the key elements to cushioning an economy from tariffs is the exchange rate going down, making it more competitive, offsetting some of the added costs that are coming from the tariff. And we're seeing that manifest in markets. So just this morning, we're trading down to around 68 cents on the Canadian dollar exchange rate. That's the weakest we've seen in over 20 years. And that positioning favoring the US dollar that we've had in the funds is providing a significant cushion as far as the value of investor portfolios right now. The second thing that we're doing is actually trying not to get too caught up in the news. It's hard to do, but what's really important, as you mentioned, is the long-term outlook. And we're trying to achieve client outcomes over multiple years, not today, tomorrow, what have you. So we're less sort of anxious about the near term and more thinking about what this means more broadly for financial markets and asset allocation. So what does it mean for the value of bonds and stocks in the long term? What does it mean for Canada's place in the world, the status of the US dollar as reserve currency? So those are the questions that are occupying ourselves and our research team. One thing we're definitely not doing is overreacting to news, which is almost always a bad idea. But again, we're very much focused on those client outcomes in the long term and trying to burn through that noise to make sure that that remains what we're relentlessly focused on.